Well, what is the real debt if we were to use the same accounting methodology that we have to use corporately and privately? It's about 210 trillion. That's what we actually owe. Okay. And you know what? You don't tend to see that in print.
Well, hello to all of you. My name is Dawie Roodt. I'm the economist at the company called the Deflation Group, and you are watching WorldView. And this is a podcast where we explore everybody's perspective, which can broaden our worldview. And somebody that certainly is going to broaden our worldview is Uli Kortsch. And he's from the Monetary Trust Initiative, and he is also the founder and the president of Global Partners in Investments. And he's written books, of course. People like this always write books. The one book that I've got 2 books here, and maybe you can correct me here. The first one is The Next Money Crash, and I would like to talk about that. And the other one is The Next Money Crash and the Reconstruction and a Reconstruction Blueprint. Well, good day to you, Uli. It is really a privilege. It's wonderful talking to you all the way from somewhere in the United States, I believe.
Yes, well, the mountains, I'm in Boulder, Colorado. We are right on the bottom of those mountains. I can walk out of my place and walk up mountains.
Well, there you have it. Beautiful. Is that the background, more or less, what it looks like outside your window? Or is that just a picture?
Not quite. No, I'm not that close.
Anyway, you should have said yes. You should have said yes, and I would have been properly jealous on that. Listen, it's really an honor for me to talk to you. And I've watched a couple of your videos, and I would like to explore some of your views on certain things that you've said there. But before we get to that, maybe you can just give us a bit of a background. I understand you're German, and I understand that fled is perhaps a bit of a strong word, but you left Germany. You were relatively young when you left Germany. Your father was a great inventor. You went to Canada initially, and then you ended up in the United States. And today you're a US citizen, but you can speak a number of languages. Maybe a bit of a short background on your interest in money, where that come from, and your journey from early childhood in Germany to where you are today.
Thank you. Good to be with you, Dawie. And I appreciate the videos that I've seen of you, and your economic perspective and knowledge is very, very good. It's really great. So I grew up in Germany, and then my parents emigrated, and so I went with them. My father invented vinyls. He had the first 5 patents out on vinyls. Which you're probably using or touching something with vinyl right now. I mean, it's ubiquitous. It's absolutely everywhere.
Yeah.
And then my father went over to pollution control. So he went from sort of the top end of the plastics industry to the top end of pollution control. For myself, my initial technical background was in radiation chemistry. I ran nuclear accelerator. Meaning there's a whole bunch of technicians that really ran it. Let's not kid ourselves. But I did the experimenting and worked on electron structures, and then walked out, and was actually a missionary for a good number of years, working on medical relief and that's really what brought me to where we're at in a whole bunch of different countries, especially the developing world, and started realizing that here were poor people, especially in the developing world, and they worked 10 hours a day, 7 days a week, and they had trouble putting food on the table. And I'm going, there's something really wrong. These people, they're not stupid. They're not lazy. What in the world is the problem? And this was a challenge to me for probably 5 years, where more and more I started complaining. And the organization that I was with, maybe it sounds a bit negative, we were sort of like a Santa Claus, out to help everybody. And I'm going, that's not the point. If somebody's naked, yeah, okay, give them clothes. If somebody's starving, give them food. But that doesn't solve the problem. You got to create jobs. You have to create stability. You have to create a system whereby these people who are hardworking, who love their children, etc. I remember I was many years ago. I was invited to consult for a child development agency, and so I went to Ghana on their behalf, and they said, "So, how do we do this? They had never worked in Ghana before, so I went up there and looked, and I said, why are we supporting children? I mean, I'm not saying the children don't need the support, don't get me wrong, but these people love their children. It's not that they don't love their children, they don't they can't support them. So how do we create support structures for the adults so the adults will help the children? And then they had a global conference. The same organization had a global conference of all their top people from around the world, and they said, we want you to speak. And I said, you don't want me to speak. You're not going to like what I'm going to say.
Yeah.
No, we want you to speak. And so I said, okay, I'm warning you, you're not going to like this. And so I went and spoke. And that's basically what I said is, could we create systems that create jobs, etc., within the structure of what it is that they're doing? And we can help with that. Well, I got about half or three quarters through my speech, and especially the Africans in the audience started standing up and yelling, literally yelling and interrupting me, and pointing to the board of directors and saying, this is what we've been telling you. Listen to this man. We've been telling you this. Why didn't you guys ever listen to us? Now you're listening to him. We've been telling you this. This is what we need to do. I thought, I did warn you. I did warn you. Anyway, I still didn't have any answers, because micro enterprise and various other things that we can put into place, they don't really solve the problem, and the whole world is not full of entrepreneurs, and micro, if we're going to set up micro enterprise systems, that demands that the person who does it is an entrepreneur. Well, entrepreneurs are, I don't know, I'm not a sociologist, 5%, 3% of the population. The rest of the people, they just want to do what needs to be done so I can
Yeah.
take some money home and I can eat. And it was Christmas in 2012, I don't know, relatively recently, where I feel I had a real download. Look, there's a whole different way of doing this. And oh, you're really getting the so that was Christmas, and then all of January I just started making notes to myself, and I ended up with 4 pages of just point form. Oh my goodness, if we did this, it would solve this problem, it would solve this problem, it would solve this problem. And I thought, this is crazy. I never talked to a soul about it, nobody. And I finally said, okay, this is really insane, Kortsch. Who the heck do you think you are? To reinvent the global monetary system kind of idea, because that's really what it boiled down to. And so then I started making some phone calls, and I ended up connecting with an Argentine economist who was part of the big changeover in Argentina in '98, I think it was, when there's a huge change in Argentina, and so he was one of the top economists involved in that. And he says, well, look, I'm going to be in your area. I said, well, come to my house. I need about an hour and a half. So I gave him my 4 pages of point form and walked through it. I'll never forget what he said. At the end of the hour and a half, he said, Uli, you're a really nice guy. I really like you. But you're totally out of your mind. You're out of your mind. You're crazy. And I thought this was really good. I thought I had some really good ideas. Anyway, he calls me back two days later, and he says, I have thought of nothing but our time together. This is unbelievable. He says, man, we have got to do this. What do you want me to do? We've got to do this. Well, then I was on a roll. Then I was on a private think tank here in the U.S., and the chairman was the prior runner-up to become president of the Federal Reserve Bank. And so I knew him, and I had a cell phone number, and I called him. I said, hey, I need about an hour and a half of your time. I got to talk to you. I have some ideas. I got to go through this with you. And well, about 15 minutes in, he said, stop. He says, I know exactly where you're going. It's basically Fisherian economics. He says, I'm the chairman of a small bank. We have got to do this. What do you want me to do? We have got to do this. And then as a result of that, I set up the whole conference at the Federal Reserve Bank. on basically on Fishery economics, or it's called all sorts of different things depending on your background, and it's been going ever since. So then, I was asked to put a conference together to change the constitution of Switzerland to change back to the money system they had actually decided on over 100 years ago. And then same with in Athens, under the auspices of the governor of the central bank there in Athens. So that's kind of my story. And ever since then, I'm doing what it is that I can to basically get that out.
Well, listening to you, if you're coming from Germany, and if you come from Germany, there are a couple of things that Germany really stands out for. One is hyperinflation. Another thing about Germany that stands out is the economic miracle, and a couple other things standing out for Germany as well. Your books sort of hint at something to do with money. You just mentioned money. I've watched some of your videos about infrastructure and how the Americans can actually fund infrastructure without debt, or a kind of debt, or not really debt. You've got a specific terminology that you use there. So I guess that you've got this thing about money. Money is important to you, and I guess money is at the heart of your plans, of your 4-page plan that you've proposed. So maybe you could give us your idea of money. What is money? Where does it come from? How is it created? Can we use money to fund certain things like infrastructure? Does it mean money is debt? What's money?
Well, money is definitely not the rand bill in your pocket. That is sort of or the dollar bill in my pocket. That's a really, really small percentage of what we call money today. I remember I had an argument with one of the members in the IMF some time ago, and I was saying to him, like currency, so coins and bills constitute about 3% of all the dollars out there. He says, no, they don't. You're wrong. I'm going, I thought I knew what I was talking about. He goes, it's not anywhere close to 3%. Uli, it's less than 0.5%. That's the IMF saying that. And a huge percentage of that, at least from the American perspective, is what we call bennies, because on the $100 bill, the picture of Benjamin Franklin is on there. And so we call them bennies. And bennies are what finance prostitution and smuggling and gun running all over the world. They're all paid in US $100 bills. So a huge portion of this 0.5% that's that kind of currency is actually international. It's not even in the United States. Okay, well, what's the rest? Let's call it 1%. It's a nicer number. What is the 99%? It's electronic money. It's in your bank account. And what virtually no Americans understand, it's not even legal tender. People don't understand their bank account, the money that's in their bank account, is not legal tender. So you ought to try to pay your taxes with legal tender, and the IRS won't let you because they want the electronic variety. Okay, so what is money? Money is created through debt. I'm going to simplify it. Let's call it 100%. That's not totally true, but that's close enough. So when you go to a bank and you say, hi, my name is Dawie Roodt, and I want to borrow money to buy a car. And so they look at you, go, okay, you got a pretty good credit rating and all that kind of stuff. Okay, we'll lend you. Let me go back to US dollars. It's easier for me because that's the currency I live in. So let's say I want to borrow $30,000. So the bank says, okay, cool. And so you sign a contract for $30,000. Let me explain what basically everybody thinks happens. Okay, so the bank then has that $30,000. They move it into, let me use my name, into my account. And then let's say I want to buy a car that's American made. Keeps everything simple. So I'm going to buy a Ford. So I go to the local Ford dealer and I pay the Ford dealer the $30,000 plus extra. It's obviously extra, but let's forget about the extra. And then the dealer pays the $30,000 to the Ford Motor Company to manufacture the car, and the Ford Motor Company pays the $30,000 to the worker. And wasn't I lucky? That worker happened to be banking at my bank, and he deposited that $30,000 into my bank so I could borrow it. No, that's one big circle. That money came from nowhere. Well, where did it come from? Well, it didn't come from the bank because that came from the worker, and it didn't come from me, and it didn't come from the dealer, and didn't. That's not how it works at all. What actually happens is, I go to the bank and I sign a contract for $30,000, and the bank, what we say ex nihilo, out of nothing, creates that $30,000. It did not exist before, so my loan creates U.S. dollars. That then goes to the dealer, goes to the manufacturer, goes to the worker, and etc. All right, let me stop at that point. Let's say I'm going to use I'm just trying to keep simple numbers here. So let's say my interest rate is 10%. I hope not, but let's just say so. Okay. So I have a really, really good year, and I sell 1 million copies of my books. I doubt it, but okay. And at the end of the year, I go to the bank. I say, man, I've had a fantastic year. I want to pay it all off. Well, let's say I've made no payments all the way through the whole year because I didn't have to. I'm just trying to keep everything simple here. So at the end of the year, what do I owe? Well, I owe 30,000 principal plus 10% interest, which is $3,000. So I owe a total of $33,000, right? So I pay the bank the $33,000. What happens? Well, the $3,000 in interest, that is direct income to the bank. They're making money out of money they themselves have created. It's good business, sort of. Well, there's downsides to that business, but anyway, all right. What happens to the $30,000? This is what really blows people away. The $30,000 did not exist to begin with, and when I pay the principal, it disappears. It doesn't exist anymore. So in order for there to be US dollars or rand or whatever in circulation, we have to do two things. Number one, every time somebody pays a principal on their house or their car or any kind of a loan, or by the way, their credit card, same, all the same business, okay? We are destroying dollars. So in order to keep the same dollars in circulation, we have to create new debt. Doesn't stop there. Okay, we have a growing economy. In order to have zero inflation, we can talk about velocity. Let's keep velocity out of this just for the time being, okay? Let's assume velocity doesn't change. It is changing. Let's just assume it doesn't change. When the economy increases, the amount of money in circulation has to increase, which means the debt has to increase. That means I, as an American, have to borrow money so that the international drug cartel has bennies that they can pay their people with. What a wonderful situation. That's money, ladies and gentlemen.
Yeah, if I may make one or two comments on that.
Yes, please.
Yeah, for one is you making use of your example. Yeah, I think basically you explained it correctly. I think that is correct. The only thing that can add to that is that the lending out of the $30,000 and the eventual redeposit back into the bank, it happens at various levels, and there are many transactions happening in the banking system. Of course, not only your transaction, many other transactions happening as well. And one can argue that the lending out and the depositing back into your example happens simultaneously because there are so many other transactions happening. The reason why I mentioned that is because that $30,000, one can argue, was actually funded by another deposit. In a way, it's not a chronological process whereby you lend out $30,000 and then the deposit comes back later. It happens all simultaneously in a way because there are so many transactions happening. That's the first one. The second comment that I would like to make is that this whole process starts off with somebody starting the process, and starting the process happens when a central bank creates the first dollar that goes into the banking system, which is called high-powered money, or so-called base money. And the third comment I want to make, it's not the banks. I can always also argue it's not the banks actually creating this money. It was actually you, because the act of borrowing the money from the bank is the same as the act of creating the credit for you. Exactly. So pointing the fingers at the banks is not necessarily always the right thing. It's as they say, it takes two to tango.
No, I agree. It is simultaneous. I'd probably argue with you on the central bank because those are reserves. Now it's not the same. It's not the same in every country. Now I realize that. And reserves in the developing world. I know I was in Uganda, good number of years ago, dealing with central bank there, and where reserves were still used to control the amount of currency and inflation in action. That's not what we do anymore today. I mean, I have direct quotes from the Bank of England
Yes.
where they explain very clearly, if you need reserves, we'll create them. Mind you, we're so overloaded with reserves right now because of QE, especially any of the countries that sort of QE, so quantitative easing. Sorry. For those of you who aren't familiar with the term QE. So especially the hard currencies, so Japan, the euro, the British pound, the American dollar, where we have created enormous number of reserves. The way that does, the central bank creates the money out of nothing. Same thing, and they go to the primary dealers, the banks, to purchase government securities, because certainly here in the U.S., the central bank is not allowed to purchase on the primary market. That's against the law. It's called debt monetization. Well, we do the same thing anyway. It's all a bunch of...
Doesn't matter anyway. It's the
doesn't
same
matter
thing.
anyway. Exactly. I totally agree with you. But what that does is massively overload the bank, the commercial banks now, with reserves in their accounts at the central banks. So we have, I think the Fed today is about at 8 trillion, something like that. Let me stop just for a second and totally change the subject, sort of, because I know we're going to talk about this T word more and more, trillion, because that's kind of the world that we live in today. And I want to, we can't get our head around trillion. I know it's a one with a whole bunch of zeros, but it doesn't mean anything to me. But I finally found a picture that I find means something to me, and I find it means a lot to a lot of people. Most of us can get our heads around 1 million. Okay, that's okay. I get that's a nice house. That's okay. I can get my head around 1 million. All right. Well,
very nice house.
Sorry.
A very nice house.
Yeah, exactly. Yes. So if we were to spend $1 million a day, in what year would we have had to start so that by today we would have spent 1 trillion? Well, you can get your calculators out. I'll help you. It's 500 years before Christ. And if we spend 1 million every single day for 2,500 years, today it would be 1 trillion. That starts to show us the insanity of what in the world we're doing from a federal deficit and a debt. And I know in some of your videos, Dawie, you address that, where this is beyond insanity what it is that we're doing, because it's never going to be repaid.
No. Let me. So basically, what we've come to realize is that money is created out of nothing. Nowadays, it's called fiat money. Money is created by central banks. They are monopolies. Governments spend huge amounts of money that they've borrowed from you and I, and it's funded by money created out of nothing. Basically, that's what it comes down to in a way. Yeah. And then in between all of this is you and I borrowing $30,000 to buy a new car. But now the money is really, the world is absolutely drowning in money at the moment. Yeah. Central banks, they've cut interest rates down to zero, basically. They're doing stuff like quantitative easing, which is a fancy word of saying we are printing money. They're doing things like yield curve control, for instance. What I'm seeing today from last year with the lockdown, the global lockdown because of the pandemic, and what we saw in 2007 and 2008 is there are similarities here. So my question to you is that who caused all this havoc on the world financial markets in 2007? And I'm going to get to 2020 just now to ask you who caused the current. Well, what can you call it? We find ourselves, somebody must be blamed for this. But what causes the 2007 financial crisis and the Great Depression thereafter? Was it money?
Well, I certainly disagree with the Vickers Commission. So the Vickers Commission was created after the 2007-2008 crash in order to investigate what actually caused it. And I agree with Larry Kotlikoff, who's a friend of mine. Larry Lawrence, who's very prolific. He's the former chief economist on the U.S. Council's president of economic advisors. He's not a nobody, okay? If I may quote him, instead of me saying this is my idea, basically it was created through government direct government interaction into the real estate market,
Mhm.
whereby what the agencies. So here in the United States, what we call Fannie
That's
Mae,
Freddie Mac and
Fred.
Fannie Mae. That's Freddie and Fannie.
Exactly,
Yeah.
exactly. And the federal government through Congress used them because they largely control the funding of the U.S. real estate market. Not totally, only well, from a housing perspective, probably 80% of the houses, because the top 20%, and I'm not sure on that number, but that's about right. Uh, the prices are too high, and you cannot resell your debt to Fannie and Freddie. So the way it works is you go to your bank, or more and more these days, a private mortgage creator, and they'll create the loan for you, and they immediately sell that loan back to one of the government agencies. Okay, that's how it works. So it's not that the banks or the private creators actually have the money to do that. Fannie and Freddie does. Okay, and they create secondary markets. They do all sorts of fancy stuff. We can talk about it if you want. But anyway,
No, 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 no need to. Right.
um, and Congress mandated that these agencies, Fannie, Freddie, Ginnie, that they essentially have to have a certain percentage of their portfolio in loans that, I'm going to be really crass now, are impossible to be repaid. And so what they did, they sliced and diced that into all sorts of types of securities and sold them on the understanding, and sold these globally, all over the world, trillions of dollars, okay, on the understanding that the securitization process that they ended up creating was clean and was good, and the probability of a default was, hey, this is AAA stuff. Everybody, it was basically rated as junk bonds rate through the securitization process, and then they started collapsing. And the problem is when money gets tighter, which it did at that particular time, then the collapse creates further collapse. It's a snowballing. It's like an avalanche, and
Mm.
can start it as a small snowball, and by the time you finish, you're tearing houses apart. Well, in this case, that's exactly what happened, and so the effect on millions of people was really awful because of congressional decisions that were made, and we came within hours of the whole global system melting down within
Yeah.
hours. Um, and only by direct steps. I actually have a list on my computer. The Federal Reserve ended up issuing $19 trillion worth of lines. 19 trillion. Two different central banks, which then moved them to banks to try to cover. Now most of that was never drawn. Don't get me wrong. It's not that they actually issued 19 trillion in loans, but they issued 19 trillion in lines. And I have a daily chronology, day by day by day by day, what was issued in lines and then what was actually drawn on. So we never got close to drawing 19 trillion. But now that you know how big 1 trillion is, does 19 trillion make any sense? But that's what it took to rescue the world from decisions that were made here. Let me, if I may switch, Dawie, let me
Sure.
switch to you. So in South Africa, or in Africa generally, what was the effect of that? What did you feel at that particular time with the 2007,
Yeah.
2008?
Yeah, I must tell you that I totally agree with the explanation. I can maybe add one or two things to that, and that is that central banks are very, very powerful institutions nowadays. And I think the Federal Reserve in the US is the biggest central bank in the world. Everybody's taking the lead from the Fed. We
Yeah.
follow the Fed interest rate patterns. We follow the Fed's policies to a large extent. Whatever the Fed reckons is fashionable to do, we do that. We even in South Africa tried our hands on quantitative easing not too long ago. So we do all the sort of stuff. The Fed, in a way, the Fed and the New Zealand Central Bank, by the way, they seem to be the leaders in a way of monetary policy internationally. And I
They,
think
they
one of the biggest,
yeah, I agree with you. Yeah.
yeah, yeah. And one of the biggest mistakes the Fed did, not only the Fed, the big central banks globally, is that interest rates were simply too low. Money was simply
No, I
too
know.
cheap. It's really as simple as that.
Yeah.
And with money being too cheap, people started borrowing money and they sliced it and diced it, as you explained, and put it into all sort of financial instruments. And a lot of that money was not AAA quality. That was
No.
bad loans that were sold off as AAA
Exactly.
quality.
Yeah.
And then eventually somebody realized that there's something stinks a little bit here, and they started selling this stuff
Yeah.
because the central bank was trying to hide the bad quality of these loans behind a wall of very low interest rates.
Yeah.
But eventually the truth came out, and everybody holding these assets, the asset prices started to fall, and that led to the financial meltdown. So it was actually central banks that were at fault, if you ask
Yeah.
me.
Yeah.
And they're repeating the same mistake. They're doing
Oh
it
my
today
God.
by
Yeah.
cutting interest rates to ridiculously low levels, by printing money out of nothing and thinking they're supporting the financial system in the process. Yes, they are in the meantime, but they're simply making the problem get bigger and bigger. In the case of small open economies like South Africa, the impact was devastating. Remember, in the case of South Africa, it's a good thing about being South Africa is that our financial markets are exceptionally well regulated. They are very much integrated with the rest of the world. And the problem is also very, very liquid. You won't believe it seeing this in Africa, but our financial markets really do work well. We have, and I'm very proud to say that we have financial markets that can hold a candle with anybody else in the world. But there is a bit of a downside to that as well. And the downside is simply that when things goes well, money flows into your country,
Right.
your currency appreciates, and I mean everybody's happy, smiling all the way to the bank. The opposite happens when there's some sort of crisis internationally, and if you don't have what you call a hard currency, and if I'm not mistaken, you mentioned the US pound, or rather the British pound is one of the hard currencies as well. I would rather call that a developing country, but nevertheless, the pound.
I know what you mean.
But the reality is that nobody wants to hold onto emerging currencies when something goes wrong. You want to run and hide somewhere where you feel safe. And the place where you feel safe is the US dollar or the euro or the yen. And nowadays, maybe even the renminbi. But the place where you feel safe certainly is the US dollar. And what happened in South Africa, suddenly there was this financial crisis globally. Nobody knew what was going on really initially. It was difficult to figure out what was going on. Everybody is running away from risk and perceived risks, and Africa is a risky place.
Yeah.
So suddenly our currency collapsed. With our currency collapsing, we saw, of course, inflationary pressures picking up. Initially, that tightened monetary conditions in the country quite significantly. The banks stopped borrowing or lending money. People stopped borrowing money. And that forced the financial system to come to a standstill, much worse than in the big countries like, for example, the US, where the Fed went out of the way, as you explained, to provide liquidity and do these sort of things. You can't do these sort of things in a small emerging economy like, for example, South Africa. So, and the effect of that was then, and it lingered, it's still lingering around, things like, for example, huge increase in the fiscal deficit, which we're seeing still in South Africa, and recently another crisis that we experienced, and a currency that is extremely volatile, which in itself is a bad thing. Very high, relatively high interest rates, because we have to increase interest rates to make South Africa relatively more attractive, to get some of this money to come back into the country, because we're a capital scarce country. And we will simply hang out to dry. Because obviously the Fed is going to look after the US economy first. And the the European Central Bank, they're going to look after whatever is important to Europe. They're not really concerned about us initially. And our credit line simply dried up. So it was havoc. It was, I'm in the financial markets. I manage stuff locally and internationally on the financial markets. And it was, I can tell you, it was a nightmare. My clients called me. They said, listen, but everything is collapsing. Suddenly I'm poor. What am I going to do? I'm angry at you. I'm going to wait for you with a lead pipe around the corner because you got me into invest in this and that. So it was certainly tough. And I think the only difference between small countries like South Africa and big countries like the US is that our ride was pretty much the same, only much, much wilder.
Yeah. Yeah, I know we say around here, if you call the US the elephant, when the elephant sneezes, everybody else gets pneumonia.
Exactly.
Yeah.
Exactly. And I think the US dollar will remain the dominant currency for a very long time to come still. And the most important for that is simply because of the very deep capital markets that the US has. I mean, if you trade in the renminbi for that matter, and you've got a surplus of renminbi, what are you going to do with that? because you're not
Right.
allowed to invest in Chinese capital market instruments
No.
because you have to have a quota before you're allowed to do that. It
Right.
doesn't, the Americans, they don't care about that. The Americans, if you've got a lot of extra dollars, you can go and buy treasury bills. And the Americans are quite happy with that because they're running a massive current account, but an even bigger fiscal deficit.
I know.
And they need this money back. So in a
Yeah.
weird kind of way,
Yeah.
we lend money from they lend us money, the Americans, and we give it back to them to fund their own fiscal deficits in a way.
I know.
But let me go back to you again, Uli. So
Okay.
what we currently have, we've got central banks doing the same thing all over again. They've got money, making money out of nothing, money very extremely cheap. They yield curve control and quantitative easing and that sort of nonsense. The financial markets are loving it. The financial markets are on
Yeah.
a high, record high levels.
Yeah.
And everybody is, again, smiling, running all the way to the bank. But is this going to last? And if
No.
not, how long? And what's going to follow? Is it going to be inflation or deflation?
No, that's not going to last. That's why I use that not a subtitle, but in my book, The Next Money Crash Dash, and here's a reconstruction blueprint as to what is it that we're going to do to come out of this. When money is free, the cost of money is the interest rate, right? So when money is free, which it is right now, basically interest rate is zero. Certainly, if you're on a borrowing ability, then the misalignment of investment is unbelievable, because you
Yeah,
can't tell. Price discovery doesn't work. What we call price discovery, which is
exactly.
when you look at bonds, houses, assets. Doesn't matter what it is that you want to invest in. If the price of money is zero, then you can't figure what the value of something is. Mathematically, we use net present values. Well, net present values basically go to infinity if the price of money is zero.
Exactly.
So, it doesn't mean anything. The problem, one of many problems that you would agree with, Dawie, I know, is the with that zero cost, assets inflate like crazy, but they're not measured in our measure of inflation. So, for instance, the Fed here, we don't use housing prices or bond prices or anything else in the price of inflation. We use the equivalent rental. Well, rental doesn't move in the same way as the actual asset price, and so true inflation is not measured by what it is that the Fed measures as quote inflation. And one of the reasons is probably because it can't. We'd be bankrupt if we did, because the amount of debt that the federal government currently has on its books, um, there's no way we'd ever be able to afford the interest. Let me talk about debt just for a minute, because I think people don't really understand how debt works for the federal government, federal accounting. Let's talk about us personally. So, let's say again, I'm going to use U.S. dollars, and I'm going to use a U.S. kind of a system. So let's say that I go out and buy a house, and let's say the house costs $500,000, and I get a $300,000 mortgage. Okay, just whatever numbers. Okay, and let's say that my payments every month are $5,000 a month. I'm just round numbers. Okay, um, so I move into my new house, and I make my $5,000 payment. And the next month, my wife, it's always the wife's problem. She says, "Look, honey, we need a new kitchen." Okay, and okay. So what I do is credit card. If I have a good credit rating, credit card. I mean, for years, my credit, my interest on my credit cards was literally zero, literally zero. Okay, well, I'm going to put it on the credit card. So what I do, I put $20,000 on the credit card, and then well, I can't make my $5,000 mortgage payment, so I add that on top. So that's $25,000 now I put on credit cards. Okay, and the next month, I can make my $5,000 payment. And the next month I can't. Whatever. So the question is, at the end of a year, what do I owe? Well, I owe the $300,000 mortgage minus 12 months worth of principal payments. Let's say that's $500. Let's just call it
Yeah.
zero. I mean, it's almost zero. Let's just call it zero. Probably $500. This is probably all it is. All right. And on top of that, I owe $25,000 in credit card debt. Is that not correct?
Yeah.
So I now owe $325,000.
Exactly.
Correct? Now, that's you and me. That's how we live. Okay, let's go to the federal government. So the federal government, same kind of thing. Let's just stay with a house price. If the federal government would have gotten the mortgage for 300,000, would have put the credit card, put 25,000 on the credit card, what in the accounting system of the federal government, what would they owe? I'll tell you what they owe. They only owe $25,000. They don't owe the 300,000. You go, what? That's right, because they only owe what they put on their credit card. They don't owe what is contractually owed. And you say, well, the federal government doesn't have a credit card. Yes, they do. We call them treasuries. Okay, they issue treasuries. The federal government only owes the treasuries that it has issued in order to cover its current deficit, added up over the years. Okay, so the federal government does not owe the 300,000 legally. It only owes the 25,000 that it has issued in treasuries. Well, what is the real debt if we were to use the same accounting methodology that we have to use corporately and privately? It's about 210 trillion. That's what we actually owe. Okay. And you know what? You don't tend to see that in print.
No, you don't. But I'm going to press you on this one. So tell me what's going to happen now. So we've created all this debt with you. Well, we as well, by the way, in South Africa.
Yes.
Not the same sort of, not so many zeros I can add.
No.
But for us, in the relative terms, it's pretty much big numbers for us as well. But so we've created all this debt, a lot of debt in the form of federal debt, state debt, but also Federal Reserve debt in a way, because that is what money is. So what's going to be the end result of all this? Are we going to see, the financial markets seem to think that we're going to see a bout of inflation. Some analysts, and that includes me, by the way, think we're going to see the opposite, deflation, within a year or so. So what's your view? What are we going to see in the short term?
Yeah, there are two, and you're absolutely correct. I would agree with that. There are two opposing pressures. All right. There's the inflationary pressure by us printing money and sticking money into the system, and the current, I think, short-term inflationary pressures of our commerce systems not working properly. The just-in-time system that we've adopted worldwide has broken apart during COVID, and we're reorganizing some of that. But in the process, very simple. So 2 days ago, I went to the hardware store, big hardware store. All I wanted was a particular kind of screwdriver. Okay. And yes, boom. And the very kind I wanted, they didn't have. And then yes, they had. And I said, when are you going to get this? And he said, I have no idea. I said, man, I need this thing right now. He said, I have no idea because of COVID, because the whole supply chain is broken. It's not working. Okay. That creates inflation because all of a sudden people like me, I'm desperate. It's whatever. It's a particular kind of a screwdriver, and so I'm willing to pay one. Let's say the screwdriver only costs $3 normally. I'm willing to pay twice that because I need the thing now.
Yeah.
Okay, so I did. I went online, and sure enough, I paid $7. I did. I paid $7 for one stupid screwdriver, and I'm going, this is ridiculous. For $10, I could have bought 15 screwdrivers. Probably anyway. That creates inflation. That's a short-term effect.
Yes.
Now, labor isn't. Labor is more long-term. It's very hard to lower wages, so we don't know exactly what's going to happen. But let me, on the deflationary side, and I really agree with you, debt is inherently deflationary. Okay, the debt pressures lowers our capacity to produce because what debt does is it pulls tomorrow's capacity to today. That's really what debt does. So capacity, I'm using the word capacity, but both production and services. What we could do tomorrow, No, I want it today. And that's what debt
Yeah.
does. So tomorrow gets weaker and weaker. Again, let me use the UX example. So for decades, we have had no problem having an annual GDP increase of 4%. Okay, I'm not saying it happened every year. I'm just saying it was not problematic. Okay, that's over. That's finished. Well, this year is crazy because of that's a COVID effect. But for us to get an annualized GDP increase of even 2% is probably impossible because of all the debt level that we have. And same we were talking earlier about what money is and money creation. It's my desire for more debt that as Dawie said that's what creates the money. Well, when I'm already massively in debt, I do not desire more debt.
Yeah.
uh, and that's personal, corporate, and governmental. Okay, nobody is saying we want to have more debt. The only reason the federal government is creating more debt is because of the crazy situation that we're in with COVID. They don't. It's not that they want the debt; it's they feel they have to do the spending. So that's a
Yeah.
huge deflationary pressure that's there. Um, at some point, with the amount of debt that we have, it's probably going to be overcome. When that will be, I really don't know. When we start printing like there's no tomorrow, because we can't forget about making principal payments by the federal government. We can't even make the interest payments anymore. As long as the interest rates are still close to zero the way they are now, they're way below average for the last several decades. If you look at the average, let's say U.S. Treasuries versus what we're paying now, oh my goodness, it's just ridiculous. Um, so at some point that's going to reverse. When, I haven't got a clue, but at that point
Well,
probably all hell will break loose.
yeah, well, I think about the next two comments. The one is that the amount of debt on the on the bank, on the central bank, the Federal Reserve, which consists of mostly government debt or state debt. So treasuries. I don't know what's the exact amount. I think it's about 4 trillion or so. What is that? Quantitative
Well,
easing.
it's treasuries and agencies, and just this morning I saw in the Wall Street Journal that they're going to start selling under the absolute crash of COVID, the ETFs and some of the
Yes, I
stuff
know
that they're going to start selling it.
the
And,
corporate debt.
Yeah,
They're going to start selling
Switzerland.
some of the
Oh,
corporate debt. Yeah.
yeah, that's really unusual for the U.S. I don't think we've ever done that in history. I may be wrong on that.
Yeah,
Um,
there was a time, I think, just after the war. But my point is that there's a lot of treasuries, or rather a lot of treasury bills on the balance sheet of the Federal Reserve.
oh yeah, oh yeah.
A couple of trillion. How much exactly? I don't know exactly.
That'll be more
And
than
that
that.
is that is basically fiscal debt.
Yes.
But I know everybody says that central banks are independent and central banks are separate entities and institutions. We all know that's nonsense.
That's
They're all
nonsense.
part of the same thing.
Yeah.
So basically, the Fed can simply cancel that debt because it owes the money to itself. Basically, in a way, the government owes the money to the government. You can simply cancel that, and if you do that, you cancel a couple of trillion worth of debt. So that's one point I want to make. So maybe all this debt on the balance sheet of the Fed is not such a bad thing. You can just cancel it. Nothing is going to happen. Nobody's going to cry.
Yeah.
And the second point is that maybe, and this is the second point, and this is a bit of a pet hobby of mine, and I've got a suspicion that the world economy is much bigger and growing much faster than what we are thinking. And much of this growth is actually taking place in what we call the gig economy. Like the
Yeah.
act of Googling
Right.
is
Oh
not
yeah.
captured in any economic statistics.
You're absolutely right.
There is some value in that. There must be
Oh yeah.
value in that.
Well,
But
look
it's
at
not
us right
captured.
now. Look at what we're doing right now. This would have
Yes,
been
it's not
impossible.
captured anyway. This hopefully this is going to be valuable to the viewers, but this is not captured anywhere.
No, that's right.
And it's wrong. So are we unnecessarily worried about all this debt? Because half of the debt we can simply write off and nobody's going to say anything about it. And the rest is relative to the size of a much, much bigger economy is actually a tiny amount of debt. So why not keep on borrowing, keep on spending?
I think. By the way, I agree. I agree with a lot of what you're saying. It's basically the last chapter in my second book. Oh, let me here this one. The blueprint one.
That's what I wanted to get to. Yes, exactly.
Uh, So let me. The last chapter deals with exactly issue. Let me just a little bit before then. So Bill White, who's the former chief economist of the Bank for International Settlements, that is, I call it the central bank of all the world's central banks. Okay,
Yeah, the
so
BIS, yes.
he was a top economist. He's now with the OECD. Really sharp guy, wonderful man personally, really wonderful person. But his chapter in the book is one of the longest chapters, and I say to people in the introduction, I say, well, if you get through Bill's chapter, you've pretty well got an economics degree, and he is devastating in his analysis of where we're at and what it is that we've done. Um, and it comes back to Dawie, what you said. What is really the definition of debt? And okay, again, speaking as an American, I go back um, to the Civil War here in the U.S. In the 1860s, where the U.S. country was rebuilt not on Fed dollars, but on not Federal Reserve dollars, but on U.S. dollars. And there are, to this date, you can go at the end of every single month, about a day or two after the month, Treasury issues a list of all the debt. Okay, here's all our debt. Boom, 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 boom. And then there's this weird category that is not debt. It's not included in the debt calculation, and those are the dollars that were created by Treasury. They're Treasury dollars, not Federal Reserve dollars, and they're not considered as part of debt. And what I do at the end of that chapter, together with the director of research of the Bank of England, good friend of mine, Michael Kuboff, is say, look, we can deal with this in a manner very similar, Dawie, to what it is that you said, except here are, so I've got balance sheets in there. This is what can be done. And it's non-inflationary by us using treasury dollars in order to pay for this, because the money is already in circulation. It's already in. We're not creating new money by undoing the debt definition of what this is all about. There was actually an informal meeting a number of years ago of 10 or 15 people sitting around drinking wonderful wine from the Federal Reserve. And in the midst of this dinner, so totally informal, no recordings, nothing, somebody said, so somebody explain to me, if let's just wipe this out. Dawie, exactly what you just said. So what would happen? I mean, so, and everybody goes, well, yeah, yeah, well, yeah. And these were top people in the United States. Yeah, well, yeah,
Nothing
well,
will
yeah.
happen.
Yeah. Nobody could come up with a hard answer.
Yeah. But okay, so that's the question about the money. Who owes who, what to whom, and it's not a case of owing money to yourself.
Yeah.
And the second comment of what I've made, what if the whole economy is much bigger than what we think it is? So maybe we don't have a problem. Maybe we are not heading for doomsday. Maybe we're just heading for wonderful times forever and ever. And we actually, the central banks can create even more money, and we can all buy new flat $30,000 cars.
Yeah, the problem is the control mechanism. So, like I say, if this is the GDP and this is the amount of money in circulation, and by the way, this is getting velocity, as Dawie, as you know, is dropping.
Collapse down.
I mean, we're down to, I think the US dollar now is down to 1.15, 1.13 is the latest I saw.
Yeah.
I'm not sure that ever happened in history.
No.
Certainly not in recent history. Yeah. So I don't think it's ever been there. So it's unbelievable. In other words, the amount of money in circulation has to increase more proportionately than the growth in GDP.
Exactly. Yeah.
But the problem is the control mechanism. Right now we have 12 people, the FOMC, the Federal Open Market Committee here in the United States, that they are the control mechanism. And I'm afraid they don't have a good history of forecasting inflation rates, et cetera, et cetera. If you go back over the last 20, 30 years, it's been really, really, really bad. The other thing is that their decisions tend to, especially when it comes to interest rates. Uh, and I realize that as we get down to the quote, the what we used to call the zero bound, I think it sort of still is. I mean, Europe is below this, what, 17 trillion now, I think, in global bonds that are trading below zero. But it's
Yeah,
still, it's kind
recently
of,
came down.
sorry,
Recently, yields came up a little bit, but it's still quite a lot of money. Basically, what
huge.
it means, if you lend money to a German government, you have to pay them to take your money.
I know, I know. And in Denmark, mortgages were negative.
Yeah,
Unbelievable. But so you've got this very, very small group of elites, of supposed experts, who know exactly what's going to happen, and they control this. And my response is, no, no, they don't. They control it, yes, to a large extent, that is true, but no, they don't know the future. And so I am more concerned about the control mechanism, um,
good point.
as to what it is that needs to be done. And I think we're going to overshoot. I think the political pressure, just like with Nixon, in 1971, when Nixon took the U.S. off the gold standard, and then he pushed Burns. We have word for word recordings on what actually happened. It took 30 years to correct the decisions of one man who insisted on becoming president, of being voted in again for president of the United States, who created a global situation so that he would be. This is unbelievable. This is absolutely unbelievable. And it took Volcker, almost not quite 20 years later, in order to bring interest rates to just below 20%, in order to undo what Nixon did. And then, of course, that huge crash, and I think to a certain extent 2007, 2008 still came out of the. I didn't want to go through that whole thing before when you're asking about that, because
Yeah,
those were the Community Reinvestment Act. That was late 90s. That was still coming out of the huge crash that Volcker created in order to kill inflation because of the decision Nixon made. And so then the Community Reinvestment Act was created, which ultimately created the global financial crash of 2007, 2008. One man? Really?
Willie, we. I must let me interrupt you. I just want to explore one last point, if I may, and that is your views on. So we know that central banks become these omnipotent
Yes.
organizations. These, I mean, they're acting like gods. They
Yes.
they are the guardians of money, the creators of money. They set the price
Yep.
of money. They know exactly what is going on in the economy. They've got insights that you and I can only dream of.
Right.
They're really clever people, it seems. But there's a good possibility that we may see a lot of inflation. It is a good possibility. And by the way, I've done some calculations on the South African currency, the Rand. The Rand is 60 years old this year. And in that 60 years, we've lost more than 98% of its value.
Yeah.
98. The
98%.
US
Yeah.
dollar is it's not far off, by the way.
No, no, I know it's
Not
not.
far off.
I'm not far off. Yeah.
So the point I want to make is that governments or politicians or kings or tsars, doesn't matter, they've always destroyed currencies. That's what they do, without
That's what
exception, in the
that's what
history
they
of
do.
mankind. They've always destroyed currencies. And even the dollar will come to an end one day. I don't
Yes.
think it's imminent, but it will happen. So my last question to you and your views on, is there an alternative? What do you think of private monies? What do you think of the so-called crypto monies? I don't like the word. I prefer to call it private monies. But technology has changed. What about Bitcoin, Ethereum, these sort of things? Is there a place for it in the future? Are central banks going to destroy their currencies again, like they've done in the past so many times over and over again? And will that create the opportunity for private monies to return again?
I'm mixed on that. I think in the very local level, yes. Uh, but I think like the Virgil in Austria, we've numerous examples where private money has worked really, really well. It's worked really well. We still have the VIA in Switzerland, although it's not very big, relatively speaking. Um, the moment it becomes really powerful, government will step on it because they demand control and the ability to destroy the currency. That is a power that they have. So I think on a very local level, I have a very good friend who's really working on the very local level, trying to create local small currencies. Or it's like the okay, here's another the Libra, the Facebook. Okay, so they came out here. We have this great concept, and Facebook's global. Let's not kid ourselves. And so they're going to come out with a Libra, with a global cryptocurrency or a global private currency. And it was stepped on by the Fed. The Fed said, "You ain't doing this." So they've had to massively change what it is they're doing. They're now coming out with new ideas. And you notice all of the major central banks are coming out with their own CBDC, central bank digital currency. So I think on a local basis, especially from a buy-sell, Bitcoin isn't used for buying and selling. That it's strictly at this point, it has value because people think it has value, but it's not being used in commerce. Essentially zero. There's some things happening, but very low. Then of course there's Elon Musk who says you can buy a Tesla with it. Oh no, you can't. Oh yes, you can. Oh no, you can't. And of course, it goes up and down like crazy. And in the process, he makes a few $1 billion. Yeah, whatever. But the moment they become big, like the Libra as a possibility, or any other private currency, I think the central banks of that particular country or globally, whatever, are going to step on it and say, "Yeah, you ain't doing this." Then they'll have to come up somewhere else, small again. On a small basis, yes. Yeah, I really think so. Especially, the ones that are trying to be stable coins. I say trying because some of them aren't doing all that well. But a stable coin is something that is anchored to a particular currency, to the dollar or the euro or whatever. I think so. I'm more. Let me just talk about CBDC. CBDC. I can really understand why central banks are in favor of it, because it would solve a number of the problems. For instance, the lag in timing that I talked about just a little while ago, the 2-year sort of timing in between actions of the Federal Open Market Committee and sort of what actually ripples through the economy. With CBDC, it's essentially instant. So I can understand why they want it. I'm afraid of this stuff, I have to admit. When I look at what China's doing, with their social index, whereas if you jaywalk, that'll cost you, a 10 renminbi, whatever. And we can instantly do that through the central bank cryptocurrency. I can immediately give you money or fine you instantly. Boom, 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 boom. I saw you on a camera. We have cameras everywhere. We have 300 million cameras now all over China. And I saw you do that. I know you did that. That'll cost you 100, whatever. And that's the side that scares me.
Big brother stuff you're talking about.
Yeah,
but the positive side is that we, the private sector, we can do exactly the same, and we can use that sort of technology to make sure to create state-proof lives, because politicians keep on interfering in my life all the time, and I'm pretty much sure all over the world as well. But I must tell you, Uli, this was really fascinating. It was really amazing talking to you. I really enjoyed it immensely. One day when I am in the United States, which is, well, with a bit of luck, I may be there by the end of this year, because I'm supposed to be doing the Chicago Marathon. So I will be around, maybe, if they allow me in. So maybe I'll pop by and see if I can come and say hello, and maybe we can explore some of these ideas again. It was really a wonderful opportunity for me to talk to you, and I really immensely enjoyed it. Thank you very much for talking to me.
Thank you ever so much. Although I have to admit, I'd rather see you in South Africa, but that's okay.
You're welcome. You're more than welcome to come and pop in. I can tell you it's quite cold now. I can't believe it, but Africa also gets cold sometimes. But you're more than welcome always. Please come and say hello to me if you are here. Thank you very much.
Thanks ever so much. Bye-bye.